And let me share my screen with the Excel spreadsheet. Can you guys see my screen? Okay. So the basic accounting equation, let's make it ginormously big. Yeah. The basic accounting equation, we already know it. Asset is equal to liability. Let's put some space. Liability plus equity. Now we clearly can tell that assets are divided by two. On the asset side, we have two type of assets. We have current assets and long-term assets. Or short-term assets, long-term assets, depends how you want to set. Now the liability, obviously we're going to have this current liability and we're going to have a long-term liability. Current liability we're going to discuss today, and after the midterm we're going to discuss about the long-term liability. And on the equity side, we already saw we have two parts here. We have contributed capital and we have retained earnings. We already saw from where the retained earning comes and where the retained earning goes, what reducing the retained earnings, what increasing the retained earnings, from where the contributed capital comes, what increasing the contributed capital. We already saw in 1110, back in 1110, which are the current assets. Now in chapter 10, we saw which are the long-term assets, how we treat the long-term assets, how we slowly transferring from the long-term assets into the income, which income lately goes to the retained earnings. And today again, we're going to discuss about this current liability and see what liability is and which liabilities are current. Before I do that, I want you to see something. I'm going to use here this one. Now if this is the timeline, we already know the time goes only in one direction, going forward. If you know any other directions, I would like to see that direction, but so far, even if there's somebody who went back in time, he never come back, so we don't know if the time actually going back or not. But let's pretend the time going only in one direction. So in this side of the line, that will be the future. On this side of the line will be the past. And now we're going to have present. What is the present? Present, let's say the present is right here. Right at this point is the present. So the question is, what's liability? Well, liability is related only and only to the present time. And usually the liability is recorded on the balance sheet. The other thing that we have to think about, for what period of time is the balance sheet prepared? And then you have to correct me and say, teacher, but the balance sheet is not for the period of time. The balance sheet is at the point of time. So if something exists on the statement, which statement is prepared at this point of time, then we have to realize that liability exists and only exists at the reporting date. And since we have the reporting date, on which reporting date we're presenting this balance sheet, we have to do this test and asking ourselves a question. At the reporting date, since the balance sheet again is prepared at the point of time, at the point of the time that we're preparing the balance sheet, does the company have any present obligation to pay something in the future for which it did something in the past? For example, if the company used the cell phone services in the past and hasn't paid yet the bill for the telephone services, at present time when we're presenting the report, company has liability. Why? Because the company has to, today, company has to pay in the future something for something that company did in the past. Let's say the telephone bill is $50. The company didn't pay $50 or use the telephone services for $50. So today, company has a liability. Today, company has obligation to pay $50 after 10 days for the service that used in the past. If the company has already paid the $50, there will be no liability. And since, as you can see, the time always change, always go with the present time, every time when we're preparing the report, and since the report is at the point of time, at that point of time, we have to do this test. That's why it's interesting. On December 31st, the company can have a obligation to pay $50, which represents a liability, which company paid, but on January 1st. But since we're preparing the report on December 31st, the company has a current liability for $50. That's the kind of idea with the liability. So now let's go to the slides and let's start working on the slides with the liabilities. Let me share my screen. And let's just go with the definition. Liability, again, is the future payment of assets and services that company currently is obligated to make as a result of something that the company did in the past, through transaction or events. For that reason, we have all the three dimensions of time. We have future, we have present, and we have a past. So what is the characteristic of the liability? First one is the present obligation. Second one is the past transaction. And the third, future event, which future event involve settlement, either through the assets, either through the services. Let's see now what's the current liability. Current liability and the liability which is due within 1 year or the current operating cycle, whichever is longer, starting from the date that the balance sheet is prepared. For the accounting people, I know who you are, so remember it, put it in your head. 1 year or operating cycle, whichever is longer, not whichever is shorter. whichever is longer. Means that if the operating cycle of the company is less than 1 year, then you have to prepare the balance sheet in 1 year. If the operating cycle of the company is longer than the 1 year, then the operating cycle prevails. So then you ask your question, when you add the reporting date, which reporting date is December 31st. Let's say the reporting date is December 31st. Is the company has obligation on December 31st, which resulting for the something that the company did in the past, and company has to settle it in the future within 1 year or current operating cycle, whichever is longer. If the answer is yes, we have a liability. What kind of liability we have? Current liability. Long-term liability, the pure definition of the long-term liability is liability which is not current is long-term. So we're only testing, is it current liability? If it's not current liability, automatically goes to the long-term liability. Current liability are settled usually current with the current assets. Or they can create another current liability. We always have to show the current liability separate from the long-term liability. Users of the financial statements always wants to see what's the current versus what is long-term. And that comes with the presentation. Again, we're going to have current liability and long-term liability. The cutoff is 1 year or operating cycle of the company, whichever is longer. Example of the current liability will be accounts payable, unearned revenue, wages payable, current portion of not payables. Long-term liability examples will be bonds payable, which we're going to see after the midterm, lease obligation, and long-term portion of the notes payable or long-term loans, which are more than 1 year or operating cycle of the company. How are we going to record the liability? Every time when we purchase assets, let's say in this case we purchase inventory on account, means we're going to pay in the future. We're not settling the obligation at the time of the purchase. That's going to create a liability or future obligation. The normal journal entry is debit asset, in this case inventory, credit accounts payable. If we have settled that at the date of the purchase, it's going to be inventory, credit cash. But since we're not paying, we're creating a liability. Later, on the payment date, we're going to close the accounts payable with reduction of the another assets, which in this case is cash. Let's see one question here for you. Everybody agree with that C? Okay, C is the one. Yes, you're right here. Let's see this long-term note payable or short-term note payable. Sorry, short-term note payable. Short-term note payable, a form of payment which kind of guarantee that the party which doesn't have a cash later on is going to pay the cash. Now the interesting part here is that note payable, since it's kind of form of credit, there's a interest rate attached. Let's say in this case, the company purchased inventory and issued notes payable, which note payable pays 10% interest. One thing we have to make it clear here is the 10% interest is always quoted on annual base. Is that clear? Every time when you see anywhere here on the text, on the slides or the textbook interest rate, that interest rate is applicable for 1 year. That's an annual interest rate. Make sense? Okay, so let's keep going then. Company purchase the inventory and issue short-term not payable, debit inventory, credit not payable, short-term. That's it. Now, at the end of the year, that happened October 31st. At the end of the year, 2 months are passing. 2 months or 3 months. Where was that? October 31st. On October 31st, we purchased the inventory. At the end of the year, 2 months have passed, which are the months November and December. Did we use the money? Did we use the inventory? Yes, we did. Did we pay for that inventory? No, we haven't. Now the question is, do we owe interest? Yes, we do. Do we have to show that interest as an interest payable of the reporting date? Because now we're going to sit on the December 31st and we're going to ask ourselves, do I have to pay anything in the future for something that I did in the past? What's happened in the past? I issue 1 year not payable, which has to be promissory note that has to be paid within 1 year. And with that not payable comes 10%. So the question is, do I owe interest in the future for the months that already passed? And if the answer is yes, then we have to show that interest payable and respectively have to debit the interest expense. If the answer is no, we don't have to do anything. But since we already used the money and the period start ticking, and 2 months already passed, that means we owe interest for 2 months. Now what we have to do, we have to calculate the annual interest. How much is the annual interest if we're paying 10% over $16,000? You can easily calculate it. 10% of $16,000. Just move the decimal. The next thing that we have to do is to get the monthly fraction of that total amount that you're calculating at the 10% of $16,000. And what we're going to do, we're going to show the interest expense for 2 months because since only November and December have passed. And we're going to show it as an interest payable. And we're done. Now on the reporting date, we're showing everybody that yes, we use $60,000 and yes, we owe interest for the 2 months that we use those $16,000. Now what's going to happen on October 31st next year? Obviously, we have to pay for the notes payable and we have to pay the interest. We already know that the interest that we have to pay is $1,600. So in total, we have to pay $17,600. Out of those $17,600, $16,000 belongs to the note payable. The other $1,600 are related to the interest. We already show interest expense of 267, and that 267 sitting at accounts payable. So first thing that we're going to do is we're going to close that accounts payable for 267 for the 2 months. And then we're going to show the remaining interest for the next 10 months. And those two together, it's going to give us total of $1,600, which is our total interest for the 1 year. On the $16,000 notes payable with 10% interest, annual interest. Make sense? Now let's go the same thing with the short-term bank loan and operating line of credits. Now the short-term bank loan are very similar to the short-term notes payable. They are arranged with the bank or the other financial institution for the fixed period at negotiated interest rate. Line of credit is another arrangement with the financial institution and is only you paying interest when you using the line of credit. When you're not using line of credit, you're not paying interest. Now, how are we going to calculate the interest here? Interest expense will be always amount of the loan times the interest rate, which is on annual base, or now if you go with the interest rate per day, then you have to calculate the number of days. The number of days divided by 365. So in this case, the interest rate in this formula will be always annual rate. And then we have to get the how many days out of 365 that interest rate applied to. Don't worry about the leap year. We're always going to use 365. What we're going to do when we're counting the days? If we have to count the days, if it comes to the counting of days on the questions, which I doubt is going to come with the counting of the days, I'm going to try purposely eliminating the counting of the days when I'm setting up the midterm. I'm going to keep it on the monthly basis, but if you have to calculate the days, do not include the day that the money are borrowed, but include the day that the loan is paid. And that will be only for the purpose of assignments. So when you're accruing at the period end, always include the last day of the period. That's all I want you to remember. So let's do one test to see if you actually understand what we're talking about here. First one, $20,000, 9%, 90 days not payable will issue on November 1st. If interest is paid at the maturity, what will be the adjusting entry on December 31st? And how many days that journal entry will have to include? Do you understand why it's A? Explain to me, please. What's the calculation here? How many days December has? How many days the November has? Well, the 13 plus 31, that's 61. Why 60? Okay, we eliminating the November 1st, right? If we eliminate November 1st, then we have those 60 days. Having said that, do you know how it's in the real life? Forget about Pearson MLA assignment and anything like that. Do you know how it's in the real life? If I go to the and borrow money from the bank today, do I owe interest for today? The question is, again, forget about Pearson, forget about MLA assignment. We're talking about real life and real life only. I borrow money today from the bank. The bank, I went to the bank gave me $10,000. At the end of the day, who has the money? Me or the bank? You. Since I have the money in my possession, do I owe the bank interest? Yes. So I keeping those money and I return the money back to the bank after 10 days. On the day that I return the money to the bank, do I owe interest to the bank? At the end of the day, listen this, at the end of the day, who has the money, me or the bank? The bank. So do I owe money to the bank for the day that I return the money to the bank? No. This is real life. So do you see the difference? On the day that you borrow, you owe interest. But on the day that you pay, you don't owe interest, which is fair deal. Now, what's the difference between the Pearson assignments? They shifted the day on the other side. On the day that you borrow, you don't owe interest, but on the day that you pay back, you owe interest. That's the only thing. But again, in real life, once you get the money, once you get the head of the money, you owe interest. Once you return the money, no more interest. So what do you have to do? If you borrow money, borrow it at 8 o'clock in the morning. And if you have to pay them back, pay them at 5 o'clock in the afternoon. That's how you buy yourself extra 9 hours. So let's see the other question. Continuation, obviously. $20,000, 9% 90-day not payable was issued November 1st. If the interest is paid at maturity, what will be the adjusting entry on December 3rd, 31st? Do you want me to do the calculation together? Or you're fine? Okay, let's do the calculation then. Let's move to that Excel spreadsheet. Let's open the new worksheet. Let's make it some adjustments here first. Make it a little bit bigger so you can see the screen. Paste this as a picture. That's our question. So now let's see what we have. We have a note payable, correct? And that note payable, the value for that note payable is $20,000. What else we know? This is 90 days period. Period is 90 days. And what else we have? The interest. Interest rate is 9%. So the question is, first question. First question is, how much is my interest for 1 year? Can I calculate it? It's gonna be 20,000 times 9%, 1,800. That's the first thing. Now the second thing is, how much my interest for 90 days? How can I calculate it? Do I know how many days the year has? $365. We already established that. $365. So what I have to do? I have to get the 20,000 times 9% times 90 days divided by 365. So this is the interest that I have to pay for 90 days. Is that how much you're getting? I can round it to go 144 or 143.84. So now the question is, from November 1st to December 31st, how many days I have? 60 days. We already established that's a 60 days. Don't do any calculations here. Because if you do the calculation here, this one minus this one, actually you're still gonna get 60 days. So we're on the right track. We have 60 days. Excel understand it. Okay. So if we have 60 days, so how much my interest for those 60 days? There are different ways to get this. Different ways to get this amount. You can get the other way you can get this amount is you're getting the 1,800 divided by 365. You should get the same number. No, and that will be per day, right? That will be interest per day, and then time 90 days. 90 days is going to give you the interest for that period, which should be exactly the same number. So different ways you can come up with those numbers. So now that's 60 days. How can I get that interest for the 60 days? Well, I can get this one divided by 90 is going to get it per day. Then 60, I'm going to get it per 60 days. Or I can go with the 60 divided by 365 times the amount, I'm still going to get it, right? It's how you're going to get this amount is up to you. Depends how your brain works faster. So what do you have to do? Here, I can go it this way. 20,000 times 9% time in the brackets will be 60 divided by 365. Or I can go again. I can get the interest for 1 year divided by 365 to get it interest per day times 60 days. I'm gonna get the same number. When you round it up, it's gonna be that. So now the question is, what's my journal entry here? Since I have all those things, what else I can get from here? I can get my interest for 30 days. Do I need that interest for 30 days? Well, I need it because that will be the remaining of those 90 days. So how can I get that one? Well, obviously this one minus that one should give you the interest because at the end of the day, the total interest for 90 days should be equal to the calculation that you have on the top. So once you have all those numbers, what you have to do? You have to just prepare the journal entry. Let's say we have to do the journal entry for December 31st. What will be our journal entry for December 31st? Which account I should debit? In debit, I'm debiting. Interest expense. Which account I should create? Interest payable. Because if I debit interest payable, I don't have a liability. But I definitely have liability on December 31st because on December 31st I'm gonna owe interest for the 60 days that I use this note payable. So my interest here will be that amount, and the credit will be the same amount, obviously. So I have my journal entry on December 31st. What's gonna happen on when is the 90 days? If on December 31st I have 60 days, where is my 90 day? On January 30. On January 30, what do we have to do? Here on December 31st, we have to show the liability. Now we are on the January 1st. What we have to do on January 1st? We have to pay. Pay the note payable. What will be my journal entry here? Do I know how much cash I have to pay? Why January 31st, Nikki? The note is for 90 days. If December 31st is 60 days plus another 30, that should give you January 30th. Make sense? So, date of payment. How much I have to pay? How much cash I have to pay? Do I have to pay for the note payable? Yes. How much is my note payable? Let's issue this not payable. Let's go with the issuing date and let's issue the not payable. Not payable, we issue it on November 1st. What will be our journal entry on November 1st here? Which account I'm gonna debit here? Cash of 20,000 and credit will be not payable. Same amount, correct? So on the payment date, I definitely have to pay 20,000. That's out of question. What else I have to pay? I have to pay the interest. Do I know how much is the interest? Yes, I know. So let's go here. I have to put my credit. Let's do the payment. Let's do the things that we know that we have to do. Cash. I have to pay cash. And I know how much I have to pay. I have to pay those 20,000 plus I have to pay those interest. So that's my payment of cash. But why am I paying the cash? Because I have to pay my note payable, right? Once I pay the cash, do I have the note payable? No. So let's get rid of the note payable. Debit, note payable. How much my note payable? 20,000. Note payable gone. No more note payable. You don't have to worry about the note payable. What else gone? Interest payable. Let's get rid of the interest payable, which is sitting, which we created on December 31st. Debit, interest payable, and that will be that amount. And what's the last thing that we have to do? We are not in balance. We're still not in balance. How much we missing? We're missing, let's see how much. This one minus that one minus that one. And should magically give us the number of the interest for 30 days. So what is that? Interest expense. Okay, and we're done, correct? So what we can see here, we have journal entry on the day that we issued a note payable. Journal entry for the accrued liability, but that's on the reporting date. And we have the journal entry for on the payment date. Make sense? Always remember, whatever you create on the reporting date, you have to eliminate it on the payment date. So this interest payable that you're creating on the reporting date, the same interest payable you have to eliminate it on the payment date. Not payable that you issued, You have to clear it on the payment date. And you always have to make sure that the total interest expense that you're accruing here and here, it always has to be equal. Let me change this one. Sorry. That interest expense and that interest expense always has to be equal to your total interest expense that you calculated. And that's how you do accounting. If there was no reporting date, I pretend that there's no reporting date, what will be my final journal entry? What's going to change if there was no reporting date in the middle? This journal entry, those are gone. No reporting date. On the issuing date, that's what I'm going to have. So what will be the reporting date? There is no reporting date, so I don't have to do anything. What will be my entry on the payment date? Let's pretend that this note is not November 1st, let's say September 1st. If it's September 1st, there is no reporting date. In September, I'm going to have 21 days. In October, I'm going to have 31. That's 60. And on November 30th, I have to pay it. No reporting date. What will be my journal entry now? Debit. First, how much cash I have to pay? There will be change in the amount of cash that I have to pay? No. So let's do the credit. Let's do the easiest one. Credit cash. And I pay the same cash. I'm closing 200 plus the interest. Gone. Which accounts I'm gonna debit? Since I paid this one, I don't have to pay anymore. Not payable, gone, right? I'm closing the not payable. And what else I have to close? Or I have to show in this case. No, I'm not closing it. I'm gonna have to show it. I have to show the interest expense. And the interest expense is the total interest expense for the 90 days. Make sense? So what's the difference between one journal entry and the other journal entry? Is the cash different? No. Is the not payable that we're paying different? No. Is the interest expense different? How much is the interest expense in this case? 443.84. How much is the interest expense in these two cases? Same. What's the only difference? Here I have payable, which is two payables that are eliminating with each other, and that's all. That's the only difference. Everything else is the same. If I eliminate this, and if I eliminate this, I have exactly the same entry. But here I'm gonna have, the only thing is I'm gonna have this one. which when combined this one and this was going to give me exactly the same amount. Make sense? Can you see it? The only thing that I'm doing is this accounts payable that I'm playing to show that at this reporting date, I owe interest payable. If I didn't have the reporting date, I don't have to show any liabilities. Okay, let's go. I hope this one kind of help you to understand the whole idea with the journal entries and splitting the journal entry on the reporting date in order to show the uh, accounts payable, or in this case, interest payable. Let's see now, let's move from the payables, let's go to the GST. GST, let me know if you want to go for break. Maybe that will be a good time for break. Yes, we can take a break. Hey, GST. Do you know anything about GST? The main thing that I want you to know is that GST is consumption tax, which is paid by the individuals and individuals only, not by the corporations. So, in that sense, GST doesn't affect corporation income. It's not recorded as an expense for the company. It's not recorded as a revenue. Nothing. It's just goods and service taxes which are collected from the company and paid by the company. That's all. Now we have provincial sales tax, which is have a different treatment. And in some provinces they have harmonized sales tax. Harmonized sales tax was present in here in BC, and that was 2008, 2009, I believe. In that time, we have a harmonized tax, which is combination between the GST and PST altogether. People start complaining about it because technically increase the cost of the services. And after 2 years, BC moved back to the GST and PST system. Now, on the GST side, every time when we have a sales, the customer is gonna pay us GST. If we get the GST, we're gonna collecting from the customer's GST. Every time when we pay the GST, cash going out, our cash going out, and now we have the right to claim that GST back from the government. And the government's gonna give us the money back. So we always have to keep how much GST we paid and how much we collect. Now let's see the example. Assume that the business operates in province without PST. They purchase equipment for $2,400 plus $120 GST, and for the paid $100 with $5 GST for the advertising. Service revenue was earned on the business using the equipment for $4,000, and the company collected $200. What will be the journal entries? Do you want me to show the journal entry, or you want we to make the journal entry? Which one you prefer? Make it. Okay, I'm gonna copy then this. I'm copy the requirements, and let's move to the Excel spreadsheet and let's do it together. This is my Excel spreadsheet. Don't worry, later on I'm gonna post you this Excel spreadsheet. Let's label it here, not Pavel. And then we can label it here, GST. Let's make it a little bigger to be nice and neat. Spot the picture. This is what's happened. Let's go one after another journal entries. First journal entry, let's purchase the equipment. Debit. What will be our debit? We purchase the equipment. Equipment. And that equipment, for that equipment, cost us $2,400. Next thing that we paid was the GST. Now, keep in mind that the GST, we can recover it from the government. So we can claim the GST back. For that purpose, we're going to show it as a GST debit, GST recoverable. And that GST is $120. Credit, obviously we have to pay cash. And we paid the cash, and we paid exactly this amount plus that amount. Let's do the second journal entry. That will be the journal entry number 1. Let's do the journal entry number 2. Now we're paying for advertising. Debit. Advertising what? Expense. Elena, I saw you ask me questions. If you want, stay after the class so we can discuss those questions. $100 here. And debit. The next debit will be GST recoverable. And that will be here only $5. Obviously, we have to pay credit cash. Now let's do our sales. Let's sales those. Let's get this service revenue. Let's go with service revenue first. Credit. Service revenue. And we get 4,000 service revenue. But then we charge the client for the GST as well. And now we're going to have another credit here. Credit, GST, in that case will be payable. Because now whatever we collect from the clients on behalf of government, we have to give it to the government back. And that will be $200. So how much the client has to pay us? How much cash we have to get? And we get it. Cash of $4,200. Now, at this point, no more transactions. So what we can see, we have GST recoverable for the amount of 120 plus $5. And we have GST payable for the amount of $200, correct? So now what's going to happen now? So technically, at this point, what we have to do, we have to send the government letter, Canada Revenue, say, you know what, in those two transactions, we pay $125. Please give us $125 back. By the way, we did sales from which sales we collect 200 from the client, and this is the check for $200. Do you think that will be a reasonable thing to do? To send the government 200 and ask them to pay us back 225? Yeah, that will be a way better, right? Instead of we asking government to pay us 125 and then we paying them 200, we just can calculate the balance and see where we are. In this case, do we have to pay or we have to get the money back? Which one is higher, payable or recoverable? Payable. So what we have to do? We have to pay the. So what we're gonna once we pay, so we clearly have to give the government cash, correct? Let's do the journal entry, the fourth journal entry now. We know that we have to pay cash. And how much cash we have to pay? $75. Once we pay $75, what we have to eliminate something. We have on the debit side, we have GST recoverable, GST recoverable. How can I eliminate debit on GST recoverable? By crediting that GST recoverable, right? And that will be exactly the money that the government has to pay me back. Where the debit's gonna go now? The debit's gonna clear the GST payable. And that will be exactly the $200. Are we in balance? Yes. After I do this entry, how much is my GST payable? Zero. How much is my GST recoverable? Zero. And I pay the difference, $75. Make sense? That's how you have to deal with the GST. Just keep it separate, whatever you paid and whatever you collected. Then see what the balance is and go for it. Question for you. And it's a very logical question. I want you to think about this. Is it possible if if the business in every transaction that he purchased something pay GST, and every transaction that's selling something collecting the GST, and that's for every transaction, is it possible profitable business when paying the GST on the purchases and charging the GST on sales to have GST recoverable? No exempt, nothing. There's no exempt, nothing. On every transaction we charging GST, on every transaction we collecting GST and paying GST. Is it possible profitable business to come up with the GST recoverable or to ask the GST back from the government? What do you think? No, absolutely not. Why? Because you're buying less for less and you're selling for more. As long as you're selling for more, your GST, you're collecting more GST from the clients than what you're paying to the clients. Again, there's no exempt GST exempt, nothing like that. No, you're not selling Christmas goods for which you're not collecting GST, right? Don't get me wrong here. We just natural business, pure business, GST on the purchases, GST on sales. Okay, let's stop with this and let's move to the slides. Let's see what's waiting for us on the slides. So our transactions here will be obviously recording the purchase of the equipment, record the advertising expense, record the GST sales, GST that we have to pay, and the cash that we're collecting. After that, we offsetting the GST recoverable with the GST collected, and we paying the difference to the government. Harmonized sales taxes. Now, in some provinces, they have harmonized sales taxes. That will be province of Ontario. They combining GST and PST all together, and the total taxes that they have to pay is 13%. Now, same idea with the GST. There's no difference between harmonized taxes and GST. You treat it the same way. Now, provincial sales tax, that's a different thing. Provincial sales tax, they're not recoverable. In very, very, very small instances, the provincial sales taxes are recoverable, but I'm not going to discuss that today, on which instances that's recoverable. So let's put the general rule, PST is not recoverable. So if it's not recoverable, it's going to increase the cost of the purchase. Is it going to be asset? Is it going to be expense? It's going to be, that cost will be carried by the business. Now let's see this question. How much are our sales? What's the journal entry when we have sales? Let's go with the journal entry. When we have sales, what do we have? Debit, cash, credit. Sales revenue and credit with the GST payable. Okay, so is this possible answer? No. Is this possible answer? Is this possible answer? Then naturally the answer should be this. Do you have to calculate the GST in this case? Do I even have to use the calculator in order to answer this question? Are you using the calculator? Again, is this possible this to be my answer? Is it possible this amount to be my accounts receivable? No. Is it possible this to be credited to sales? No. Is it possible then to GST recoverable to be involved in this transaction? No. Again, do I need to use the calculator to come up with this answer? No. Exactly. That's another way you to come up with the answer. I want you to understand this, especially when you have a multiple choice questions. Don't jump right away on the calculator. Try to think. You're smart. You have the knowledge now. Think about it. Close your eyes. Think about it. What will be the journal entry? If you have to write a journal entry somewhere on the side, write a journal entry and go elimination. If you have doubts, then get your calculator, go for it. Be smart. I want you to be smart, please. Our current portion of the long-term debt, obviously, we always have to show current liability, long-term liability. What if we have a very, very long-term debt? So that debt always going to have a current portion. Let's say company borrow $7,500 on January 1st, 2014, which has to be repaid on annual installments, 1,500 each December 31st for the next 5 years. So what's going to happen? If it's now December 31st, 2013, the company is going to record current liability of 1,500, which has to be paid within 1 year, and $6,000 long-term liability. On December 31st, 2015, they're going to show again $1,500 current liability and $4,500 long-term liability. Until, let's say, they're coming for the very last payment on December 31st, what will be now recorded? They're going to show current liability $1,500, long-term zero. That will be before the last payment. Make sense? Now, this division between current liability and long-term liability is applicable only and only to liability. Only for the liability, we showing the current liability and the long-term liability. But that will be only on when we have a long-term liability. On the long-term liability, always have to show the current portion and the long-term portion. Keep that in mind, please. Let's go with the accrue expenses. Which are expenses we are accruing? The one that we're not paying, the one that we're using, but we're not paying. If we're not paying, what that means? We have a liability. Something happened, we haven't paid yet, that means liability. In which instances we owe money? We owe money when we're using our employee, but we're not paying them. We have a liability when we're using the borrowings, but we're not paying interest. Same thing with the payroll. Same thing with the property taxes payable. We're using the property, we know that we owe money for the portion of the year for the taxes, but the fact that we haven't paid the taxes doesn't change the fact that we owe the taxes. So we have to show that liability. Remember, again, the liability is current obligation for something that happened in the past, which has to be settled in the future. Let's go with the payroll accruals. If you have hourly employees, it's very, very, very rare circumstance. Actually, that's never going to happen. Even if December 31st is falling on the Friday, you're not paying for the current week. You're paying for the previous week. So the week from that ends up on December 31st, that will be 27, 28, 29, 30, 31st, that week you're going to pay in January. So on December 31st, you always have to accrue for the payroll for the last week. The next liability is unearned revenue. What we're doing with the unearned revenue, we're pushing the event in the future. We collecting the money, but we're not recording the revenue. Why? Because we haven't transferred the goods and the services, or the goods and the services haven't been delivered in the hands of the client. The gift card will be one, concert tickets, airline tickets, all those are different. Your cost of your course that you're paying is also recorded by Douglas College as a deferred revenue. Why? Because once you pay for the course, you haven't received any of the services. Even in fact, right now, you still haven't received, 1 month hasn't passed since the course started. So the first reporting period for the Douglas College will most likely will be January 31st. And on January 31st, then they can transfer the portion of the money that you pay them for the month of January only. They're going to prorate it over 4 months, the tuition fee, and they're going to start recognizing the revenue. Under the revenue, again, subscriber pays $20 to the Rogers for subscription. What will be the journal entry for the Rogers? They're going to get the cash, but since they haven't delivered the services yet, that will be unearned subscription revenue. When the subscriptions start coming, they're going to start recognizing the revenue slowly over the period of time. Customer deposit payable. If the customer pays deposit, is that liability? How many of you are renting? Is there anyone who pay rent? Did you have to pay a deposit before you get your place? Can you get your money back for deposit? Well, there's some conditions, but technically you should be able to. Correct? So what's that for you? That's a customer deposit payable. So let's see the next one. Current liability, which has to be estimated. Well, business, sometimes we know that there's a liability. The question is, we don't know how much exactly is. The fact that we know there's a liability and we don't know how much exactly is, it doesn't change the fact that we have to record it. We have to do our best estimate. Perfect example will be warranty payables. Before we go with the warranty payables, we have to understand why we have a warranty. Which is the event that triggered the warranty? Sell. Because once you sell, let's say I'm selling laptops. Every laptops comes with a 1-year warranty. When I have the warranty, before I sell it or after I sell it? Obviously, the event of the sale triggered the warranty. Now the question is, can I estimate that warranty before the actual warranty happened? And is this warranty actually expense for me? Well, technically, we don't know yet because we don't know how many computers gonna break and how much we have to pay in order to fix the problems with the computers which we're selling. But based on the previous experience, we can easily come up with some estimation. So instead of waiting for the customer to come and tell us my computer has broke, I want you to repair it, we're gonna accrue that warranty expense and we're gonna show warranty liability at the time of the sale. So basically, we're gonna match the revenue with the expenses. It's not actual expense because it hasn't happened yet, but we're gonna show it as a payable. And when the actual expense happen, when the actual claim happens, sorry, then instead of creating a new expense, we're gonna reduce the payable. Let's see how this is gonna work. Imagine this. This company have sales at $80 million, which is subject to 1 year warranty. Company, based on the previous experience, based on industry experience, based on the product information, they believe that they're gonna experience 1% warranty claims. So what they're gonna do? First, they're gonna record the revenue, debit the accounts receivable, so debit cash, create sales revenue for $80 million. Then they're gonna show the warranty expense. Again, this is provision now to match the expense with the revenue based on the future expectations. And then we're gonna show warranty expense, credit estimated warranty payable or estimated warranty liability. Now, 6 months later, the defective merchandises came, which has to be repaired. And they actually repair it. Can they show the new warranty expense? Well, no. Why? Because they already show the warranty expense, which is related to that particular sales. So what they're going to do now? Now they're going to start reducing the warranty payable. If they have to pay cash for the labor, they're going to pay cash and they're going to reduce estimated warranty payable. If they have to replace the products with the new products, instead of cash, they're going to create inventory. But again, they're not going to touch again warranty expenses. Why? Because the warranty expenses already be recorded at the time of the sale. What do you think about this? Yes, when the product is sold. That's correct. Not when the product is used, not the product is paid, not the product is repaired, product is sold. Keep that in mind. Estimated vacation payable liability. Every year at the end of the year, you're checking your employee records. What are the chances some of the employee haven't used their vacation? Very high, correct? If the employee haven't used their vacation, do you owe them money for the vacation time they earn? Yes. Do I have to show it as a liability on the reporting date? Yes. So let's show it. What will be that? We're gonna go with the payroll. We're adding the 4 days for percentage. 4%. 4% is equal to 10 days per year. And then we're gonna go vacation expenses, estimated vacation payable. When the employee actually use his vacation, then we're gonna reduce the estimated vacation pay liability. We're gonna pay him his salary, and then will be different. Cash, definitely we have to pay cash. If we're not paying cash, there will be other accounts. we're going to see later on the payroll what kind of other accounts they come in. Let's see with the income tax payable. Now, with the income tax payable, and that will be the end of, let's finish this income tax payable, and that's where I'm going to stop. So every corporation is required to make installments based on the estimated taxes from the previous year. Only the first year of operations and only the first year of operation, corporation doesn't have to make installments. After the first year, as soon as the company generates income and pay taxes, after that, every corporation is required to make installments equal to the at least for the last year tax paid. Now, for that reason, every time when the corporation make that installment, we're going to make journal entry income tax expense, cash. During the year, this company, which make 100,000 every month installments, during the year, they're gonna accumulate how much expenses they're gonna accumulate for the income tax for 12 months. What do you think? What will be the income tax expenses that this company is gonna accumulate if they're paying every month $100,000? How much will be the income tax expense at the end of the year, from January to December? 120,000, correct? 1 million, yes, 1,200,000, yes. So at the end of the year, when the company prepared their tax return, they found out that the actual tax payable is $1,240,000. How much they have to pay now? Do they have to pay $1,240,000? Only additional 40,000. Why? Because they already pay as installments $1,200,000. So they're only going to pay the difference between the actual taxes minus the installments that they make every month. And that's what they pay. Now first they're going to show it as a payable at the end of the year, and by January 31st they're going to clear it $40,000 once they have cash. And that's where we're going to stop.